It's total assets divided by sales. It's basically the reciprocal. Again, there is no independent information. The first one says uh, per dollar of assets, how many dollar of sales I can generate. The second one says how, how many dollar of capital do I need to generate $1 of sales. I kind of prefer the capital intensity ratio because it's similar to days sales kind of numbers. So I'm going to calculate that for both companies. Let's just use different colors. And that would be total assets, which is in the balance sheet, divided by operating revenues. Okay, let's do the same thing for delta as well. Then we'll talk about that. Actually, I think I put it in a different place. Remember, it was total assets over sales. Okay, so to generate $1 of sales, delta requires roughly $1.25 in assets. It's not that different from what you want to call Southwest Airlines. It's probably an industry thing. In general, if you want to look at contribution of different kind of assets to that capital intensity ratio, remember you can write total assets as sum of different types of assets, right? So I can write that as cash plus receivables plus other current assets plus fixed assets over sales, which means this is equal to cash over sales so on and so forth. Especially when we're doing analysis with respect uh, to figure out, the contribution of different forms of assets. This is actually rather useful decomposition. Now, let's start talking about some profitability ratios. Again, I guess the more I use it, the more it creates problems. I almost never have this on my Tuesday, Thursday sections because I have only one class on Tuesday, Thursdays. These ratios typically we express them as percentages. Tell us how much net profit do we make per dollar of something. The first one we're going to look at is profit margin, which we abbreviate as PM, and that's net income divided by sales. So from each dollar of sales we make, how much money we have left after we paid for everything, including taxes and other stuff. Another one is return on assets, which we're going to abbreviate as ROA, and this is we're going to abbreviate it as net income. Net income divided by total assets. Finally, return on equity, or ROE, net income divided by total equity. Now, there are relationships between these three. In fact, we call that the DuPont analysis. It's called DuPont because this sort of analysis was first done by the company DuPont, the chemical company, back in 1930s. I'm gonna write three versions of this. ROA can be written as profit margin times total asset turnover. Of course, you can write ROE also as uh, total asset over total equity, which is also 1 plus the equity ratio. Sometimes this is also known as equity multiplier, EM. It's kind of a measure of how leveraged the firm is. And finally, you can write uh, times ROA. ROE is actually the product of PM times TAT times equity multiplier. This is actually a nice little decomposition. It says, suppose the firm has very high return on equity. Equity is, book value of the firm. Is it high because you have high profit margin? You or high TAT, which means you are efficient in using your resources, and EM is because you have high leverage. So let's calculate all these three for our companies. First of all, let's do the TAT. I'm just gonna put everything in one place. Sales over total assets. Where are you? And we typically express that as just the numbers. I'm gonna do EM. You can write up EM as total assets over total equity.